This week, the producer price index came out a little hotter than expected, and unidentified drones continue to be seen across New Jersey, Pennsylvania, New York, and other places. Which one should we fear more? Here's the problem with both of those reports. First of all, I predict the drone worries will end up being a big nothing burger. And in terms of the CPI or Consumer Price Index, PCE or Personal Consumption Expenditures, and most recent Producer Price Index or PPI report, there were two numbers reported and one of them was totally ignored by the markets. I wasn't able to produce my normal video this past week because I hurt my back and wasn't able to sit for any length of time. In fact, it's still a little bit tough today. So this is that video that I was going to publish over the weekend with the metrics from last Friday, even though the market has opened and is well underway today. I think you'll find the metrics interesting because in general, they pointed to a higher equity markets this week. We'll ignore the drone concerns for the rest of this video, but at least these sightings and worries give us something to talk about. When it comes to the Producer Price Index and the unemployment reports that came out, do we have anything to worry about? Look, the big worry on Wall Street and Main Street is, will inflation return? And the bigger worry is, will the Fed need to start raising rates again to fight it? To better understand the relationship between equities, bonds, and the monthly change in the PPI, I created this graph going back almost 15 years. And what you're looking at here, this white line, this white jagged line, is the monthly change in the Producer Price Index going back to 2010. And you can see the percentage changes here on this right-hand axis. The blue line is the S&P 500 Total Return Index, so it's the equity index going back to 2010. And I've plotted the growth starting at 1 for that. And then the green line, this sort of fluorescent green line, is TLT, which represents 20-year Treasury bonds. So these are bonds, and we can also see how fixed income has reacted to changes in the PPI. So let's dig into this a little bit. So first of all, let's take a look at what I would consider to be normal ranges for the Producer Price Index. And you can see what I've done here. I've put these dashed purple lines on here at minus 0.4% and plus 0.4%, because kind of if you eyeball this, they represent the middle of the road and the extremes within that middle pretty well. So where are we right now? Let's take a look. We're sitting right at this top level of this normal range. And you can see, interestingly enough, that if you look at the bottoms here, these are moving higher, yes. But if you look at the tops, they're moving lower. Now, what's more important here? Let's take a look at some history. So what happened back here during the debt ceiling crisis? I don't know if you remember this, but back in sort of spring of 2011, our elected officials couldn't get out of the way to fund the government, and the markets dropped. You can't really, it's hard to tell here, but the S&P 500 dropped 20%. So what was the Producer Price Index doing then? Well, interestingly enough, it was dropping. So it was a deflationary environment. But I think what happened here in the equity markets and the bond markets, the equity markets dropped by 20%. And you can see that there was an extreme flight to safety causing 20-year Treasury bonds to shoot higher, which kind of offset the risk here if you look at it. So I don't know that this is really any correlation here between dropping Producer Price Index, and there's certainly no correlation between that and falling equities. You would think that a falling Producer Price Index would make equities move higher, but there were other things at play here that caused a flight to safety, and Treasury bonds went up. Let's see if we can find another episode of dropping PPI right here, PPI dropping, and you can see that the equity markets rose. And by the way, the bond markets went up as well. Now let's take a look and see if we can find a period of generally rising PPE. Well, you can see that was kind of happening here. And you can see during that time, equities moved very nicely higher and Treasury bonds were just kind of floating along here. Now, what happened in the pandemic? Well, you can see well before the pandemic, the Producer Price Index started to drop, and then it really tanked during the pandemic. And you can see that Treasury bonds went up very, very well here. In fact, well before the equity drop, Treasury bonds were moving higher, probably in response to the PPI coming down. But when the pandemic happened and equities dropped, you can see that TLT really shot up here to offset some of this risk because there was a maximum flight to safety. So now what happened after the pandemic? Well, the producer price index went up, and not only did it go up, it went up well beyond this normal range. And you can see that the equity markets went up as well. And why? Because the Fed was keeping interest rates low. Then in 2022, the Fed started raising rates in response to this continuously rising producer price index. And what happened? Well, Treasuries sold off and bonds really sold off as the Fed raised rates. Now, where are we now? Well, the producer price index looks like it's fairly well contained. We've got a couple of upside outliers here, but in general, it's been running kind of in this range. And you can see that the equity markets have moved substantially higher while bonds have stayed down here in the pits, because there's still a fear that the Fed could start raising rates. So yes, the PPI is on a recent upward trend. If you look at the bottoms, if you look at the tops, it's on a decline. But at its current level, do we have anything to be worried about? As you can see from this chart and the discussion we just went through, there appears to be nothing to worry about unless inflation increases and the Fed starts raising rates again. Right now, that looks really improbable, and we'll go through what the markets think about that later in this video. And I stand by my many earlier predictions that inflation will continue to come down as productivity gains continue to increase over the coming years. Are you worried about drone sightings or inflation and what the Fed might do? Please let me know in the comment section below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Well, as you can see, if we look back over the past 5 trading days, and by the way, this now includes today. You can see we're here on December 16th because I didn't record this until this afternoon. So this doesn't go back to Monday. It actually goes back to last Tuesday over the last 5 days. But you can see we have a very, very healthy rally today with ARK Invest shooting up very quickly. NASDAQ 100 on top, S&P 500 down here, and then followed up by small caps and then the Dow Jones Industrial Average. But more importantly, look at small caps are moving up very nicely, much more quickly than the Dow Jones Industrial Average. So this is a healthy appetite for risk. What if we look back over the past month? A very healthy appetite for risk. As you can see with ARK Invest on the top, NASDAQ second. You can see that the S&P is really kind of third here, followed by small caps, and the Dow's dead last. This looks really good. And then let's just jump to 1 year. And you can see that while ARK Invest really lagged over most of the past year, over the past few weeks, it's really shot up and is gaining ground very, very quickly. This is a very healthy risk appetite for equity risk. And what if we look at the current bottom dynamics? Well, there's not a lot to see here. These are really effective at tops and at bottoms, and we're not in either place right now. So these are going to kind of, move up and down. What you can get out of this is looking at this dashed line, this black dashed line. This is the confidence level. And when the confidence level is low, there's no herd behavior. When the confidence level is high or higher, there's more of a herd behavior. So you can see back here, the markets were moving up and there was some herd behavior going on here, which is very, very good. Again, when it was moving up here, confidence level was increasing and there was some herd behavior. Where are we now? Well, we've been pulling back, but actually today, which is up, I don't have that on this graph. This is as of Friday. You can see that the confidence level is moving higher. So the fact that the confidence level is moving up and the price today is moving up, even though you can't see that in this chart, that's very good. What about risk versus opportunity? Well, this looks fabulous. And, had I done this over the weekend, I'd say, boy, this looks great. You've got the opportunity level, this blue line, moving higher. Opportunity acceleration, shooting higher. This couldn't be better. And the fact that these two are above these two risk measurements is really, really good. Now, I don't like the fact that risk is moving higher, and I don't like the fact that risk acceleration is shooting higher. But it'll be interesting to see. Again, these are numbers as of last Friday. They don't include today. So now if we include the data from today, you can see the price movement of the S&P 500 is moving up, as we all know. But what I really like here and what I expected is that the opportunity level goes higher, moves higher. The equity opportunity level is moving higher. The equity opportunity acceleration is shooting higher. This is great. And just as I suspected, the risk acceleration is declining and the risk is declining. This looks really, really good, really positive. What about equity versus safety? Well, let's jump right into the overlays. So if we jump into the overlays, this looks fabulous. And you can see some of this in the price action that we saw earlier. You can see that the Qs have moved up. The NASDAQ 100 is solidly in first place and has moved up very nicely. S&P 500 moved up to third place. Now, small caps have been collapsing. They're down here in sixth place, but I like the fact that the Dow, in terms of equities, is down here in last place in seventh position. So this looks very healthy. What about safe haven assets? Well, the longest duration treasuries were up here in first place. They've gotten knocked out by the NASDAQ 100, pushing these down. TLT 20-year bonds have gotten pushed down to fourth because the S&P 500 moved up. And you can see the cash is way down here, which is great. Now, what pushed cash down, though? Gold moved up from 10th to 5th, which caused cash to fall. So this is a sign of risk aversion. But let's see if that follows through with the other metrics on gold. And how does all of this look when you look at the buying and selling pressure? Well, I got to tell you, from what I'm seeing here today, I wouldn't have predicted that the markets would be higher today, and they are. As you can see here, everything is up except for the Dow, which I'm really happy with. The Dow are safer equities. I don't mind if those lag. You've got the S&P up over 0.5%. The NASDAQ 100 up 1.5%, small caps up 1%, ARK Invest up 2.7%. This is magnificent. Now, Treasuries are sort of treading water here to slightly down. But in terms of equity risk, this looks great. And you can see if we look at the S&P 500, the buying pressure was falling as the price was rising. That's a divergence, not good. You can see that for the NASDAQ, the price was rising very nicely, and this strength has continued into today. Remember, these prices are as of last Friday, and you can see that at the end of the run here last Friday, the buying pressure started ticking up for the NASDAQ, and I have to believe if I looked at these now that this would continue higher. But small caps have really kind of floundered as of late, and you can see that in the buying pressure falling, selling pressure increasing. And what about ARK Invest? Well, similar picture. You have a divergence here, and you can see that the buying pressure has pulled back, but now it was pointing higher on Friday, so it'll be interesting to see how this looks today. And what about sector rankings? Well, if you just take a look at these, both weeks, last week and this week, these look very, very healthy. You've got high-risk assets like Bitcoin and ARK Innovation up here, consumer discretionary. This is a very good risk appetite. But let's look at sector rank acceleration, because this is telling you where things are moving and how they're shifting, and sort of more real-time picture of where we are than when you look at sector rank alone. And what's there to like here? Well, one heck of a lot. There's a lot of green arrows on this chart. And if you've watched my previous videos, you'll know that I treat the Dow Jones Industrial Average and consumer staples as safer equities. So instead of making these lines green or red, I make them brown, because they're both good and bad, right? The Dow moved down, well, those are equities, so that's bad. But they're safer equities, so that's good, because riskier assets are moving up at the expense of safer assets like consumer staples and the Dow. This is a very, very healthy looking picture. And if we look at what's bad here, not much at all. Consumer discretionary have pulled back. ARK Innovation has pulled back a bit. Bitcoin pulled back a bit. And gold shot up from last place into the upper third of this table. So I wonder what that's about. And how are Treasuries looking? Well, you can see not very good. Treasuries have fallen, with the longest duration Treasuries, EDV, down the most, TLT down the second most, and then they get better as you go shorter in duration. This is an unhealthy appetite for Treasury risk. Now, you didn't see that in equity versus safety because EDV was at the top. Now, equity versus safety uses more than one measurement to measure what's happening with equities and Treasuries. So that might actually end up being a good tell, and these could end up going higher very soon. We'll have to wait and see. What about over the past month? Well, you can see we had a very nice rally, and then things just fell off terribly. And part of this was due to the PPI report. The bond markets really acted negatively last week to that PPI report. And then if we look back over the past year, well, you can see where we are. We're kind of near the bottom of this range. So to me, these look like they're in bargain territory. And how does all of this show up in the buying and selling pressure for Treasuries? Well, you can see we had a very nice rally, pull back, rally, pull back, rally, pull back, rally, pull back. And you can see that indicated here in the selling pressure. And you can see for long duration bonds, the price is falling, and you can see that the selling pressure is going up very quickly and the buying pressure is dropping very quickly. Now, when the selling pressure gets up high like this, typically this is an inflection point. Now, could this continue dropping? Yes. Could this continue going up? Yes. So we'll have to wait and see where this turns the corner. But right now, I would say we're pretty close to a bottom here and an event where this starts to turn around and move higher. What about that yield curve? Well, the yield curve is about 15 basis points not inverted, which is great. And you can see that long duration Treasuries, the yields at least at the, oh, wow, interesting. They made that 7-year. That used to be 10. Interesting. But anyway, you can see that yields, at least at the 7-year, have come down a bit. And they're coming down at the short end in anticipation of the Fed lowering rates again this week in a couple of days. And what do the markets think is going to happen 1 day from now? A little over 1 day, almost 2 days. Well, you can see there's no probability that the Fed's going to leave rates the same. That line would be here in blue if there was any probability at all. And there's a 97% chance the Fed will lower by 0.25% and a small likelihood the Fed will lower by 0.5%. What if we go out to January? Well, no surprise that there's no blue line here, but 0.5% is in the bag, and there's a growing likelihood that the Fed will lower rates by 0.5% by then. What about out to March? Well, out to March, we have a stronger likelihood that there's a 0.5% decrease in the rates and a growing likelihood that there will be a 0.75% reduction in rates by March. And what about gold? Well, gold, it's interesting. If you go back to here, there's been sort of a rally going on, but it's been pretty much kind of going sideways to slightly up over the last several weeks. And you can see that the buying pressure really collapsed late last week and the selling pressure started moving higher. And today, gold is up just a little bit, about 0.3%. And what about Bitcoin? Well, Bitcoin has been just on a tear, as anybody knows who's been watching this. And what's interesting is, even though the buying pressure has been declining, the price is moving higher because there's no real selling pressure here. So as you can see from the price movements and the metrics, the equity markets and Treasuries have upside room to run. And I think they're going to keep looking better as we move forward over the next several weeks. Are you thinking about rebalancing your portfolio to lock in some of the big gains we've seen over the last couple of years? Or do you plan to let your gains ride over the long term? Now, hopefully you already have a fairly healthy exposure to Treasury bonds in your portfolio. But if you don't, are you thinking about adding some and increasing your exposure at this point in time? This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.